Welcome back. Well, this past year was a rough one for investors, with volatility becoming the new normal. Every day, seemingly minor news could send markets on wild swings. By all indication, that's volatility that'll continue into the new year. So if next year is anything like this year, what can you do to maximize your investments? David Kaufman is president of Westcourt Capital Corporation. Great to see you, David.
Good to be back.
So that's a pretty compelling idea, that we may continue on with the volatility, but there are things that you can do to sort of maximize returns. What's on that list?
Well, let's look first at the equity markets, because if we're going to have, say, oscillating, range-bound markets, and that is certainly expected by a lot of pundits to continue, the first thing you can do is lower some of your costs. And also assume that maybe correlations will stay high. And so that's when you'd be wanting to look at, for example, ETFs or different kinds of lower-cost funds. And you could supplant that with some income that you could derive through covered call ETFs, for example, that would increase the yield that you get when you get paid to wait by collecting dividends. That's if you want to stay in the equity box.
And, of course, you might not. You might want to look at bonds as well.
Yeah, and the other thing is that if you want to use equities as a tool rather than as an end, you can take a look, for example, at equity market-neutral hedge funds, which use equities as a tool, but they have typically zero net exposure to the markets. And that means that if they're going to make any money, it's going to be entirely because of manager skill. And then you should also take a look at allocation, as you see it in Europe and in the U.S., mostly a little less in Canada, to manage futures, which are moderately positively correlated in bull markets, but they're heavily negatively correlated in bear markets, which should let people that have large equity exposures sleep a little better at night.
You know, the probably most disappointing asset class in 2011, given the volatility, front end of the year was good, back end was disastrous, were hedge funds. They weren't hedged at all. And I think going and looking at 2012 and using active managers, long short guys, again, is going to be very hard. My bet is fund flows will continue to exit that strategy, wouldn't you say?
I think it's certainly going to continue to be a big challenge. I mean, you just said, I don't totally agree with what you said, that they weren't hedged at all. I think that the better way to put it was that the promise of absolute returns didn't necessarily materialize. And what many managers will tell you is that it's a very difficult market, especially when correlations are high. That, for example, if you're running a paired trading strategy, even if you're the best stock picker in the world, if correlations are high, you're going to end up breaking even and then losing your management fee and end up with negative returns. But there's no doubt that we're in a new normal, to use what Amanda said earlier, and that it's going to be a challenge especially for long short operators, especially if markets are oscillating.
Let's talk about inflation expectations and where that fits into the portfolio, because interest rates still rock bottom. We know they're going up. We don't know what's coming on the inflation front.
Right. We don't know when it's going to happen, but they're certainly not going to go down much further, although we would have said that a year ago as well. And so when you have people that are looking at their fixed income allocation, they can try and jack up their returns a tiny bit by going to the end of the curve, which is a very dangerous place to be if interest rates go up even a little bit. And so that what we recommend is perhaps, of course, some allocation to corporate bond funds, although there's nothing alternative about that. We also love the alternative mortgage space and the REIT space for people that are seeking a slightly higher risk-adjusted yield and lower volatility.
Let's go back to equities and what I call the Rip Van Winkle effect. If you fell asleep January 1st and just woke up, you wouldn't have seen any change at all this year, although it's been a whipsaw, wickedly volatile. In fact, if you've been asleep for the last 14 years, nothing's happened. So equities now are pretty lousy investment if you just buy the indices, aren't they?
Well, I have a not very well hidden bias against equities generally, and I agree with you. But I would think that if you went asleep long enough, that eventually, because markets do tend to rise as successful businesses continue to operate, the issue there is that the walk like an endowment can only go so far, because endowments and foundations often have infinite time horizons, whereas investors may have long-term horizons, but they're not infinite.
You mentioned alternative investments. What are some true alternative investments that you would recommend?
Yeah, if you really want to hop off the train, say I'm walking out of the casino and I want to have low correlation, inflation protection, moderate returns. I love Canadian farmland in general. The macro thesis is excellent. You know, less arable land, more people, more food. And then the micro thesis that on a per unit production basis that Saskatchewan, especially Western Canadian generally, is very well priced. And then you can go into the less liquid areas of private equity, specialty investments. We recently talked about wine funds, but there's other types of collectibles. And then you get into some more complex structured products, some of which are designed to give you higher yield, and others which are designed to protect you on the downside. But the catch there is that they're often very expensive, especially for retail investors.
And they have no yield. That's the other problem. If you got to eat, that's an issue. So where do you go get yield for 2012? Where do you think the safest place to be is?
I return right back to the REITs, especially apartment-only REITs, because they have no anchor tenant risk, and I love mortgage funds.
All right. David, great to have you here.
Thanks for having me.
Happy holidays.
And to you.
David Kaufman, president of Westcourt Capital.